Have you ever wondered how you can get a handle on a company's entire financial health just by looking at one document? Well, today we're going to crack open one of the most important reports in finance, the balance sheet, and we're going to do it using none other than Apple as our guide. All right, let's get right into it.
So how do you do that? How do you capture the entire financial story of a giant like Apple, not over a whole year, but at one specific moment in time? The answer? It's something called the balance sheet. And trust me, it's a way more powerful tool than you might think.
Here's the best way to think about it. If a company's income statement is like a movie, showing you its performance over a period of time, then the balance sheet is a high-resolution photograph. It freezes time, showing you exactly what the company owns, what it owes, and what's left over for the owners, all on one specific day, say December 31st.
Okay, so this whole thing, this financial snapshot, it's all built on one single, rock-solid idea. It's a rule that can't be broken, and it's the key to understanding everything else we're about to look at.
You know, it doesn't matter if we're talking about a trillion-dollar behemoth or your favorite corner cafe. Every single number, every line item, it all boils down to one beautiful and surprisingly simple equation.
And there it is. Assets equals liabilities plus shareholders' equity. That's the whole game right there. And listen, this isn't just some guideline. It's like a law of physics for accounting. It always has to balance. No exceptions. What a company owns has to equal what it owes to others, plus what belongs to its owners.
It's actually pretty logical when you break it down. On one side of the equation, you've got all the stuff the company owns, its assets. On the other side, you've got who has a claim on that stuff. First come the lenders and suppliers. That's the liabilities. Whatever's left over, well, that's the good stuff. That's the shareholders' equity. It's basically the company's net worth. And again, those two sides, they have to match perfectly.
Okay, theory is one thing, but let's get our hands dirty with some real numbers from a real company. And who better than Apple? So let's imagine a little scenario. We've got a seasoned financial analyst, we'll call her Kavya, walking a student, Aman, through Apple's report. This is how the pros really look at these things.
So the first thing Kavya is going to point to is a section called Current Assets. She'll tell Aman, look, these are the things Apple plans to turn into cash pretty quickly, like within a year. We're talking about their cash pile, all those iPhones sitting in warehouses, and even the money that customers still owe them. This is the fuel for their day-to-day operations. And for a company like Apple, wow, that number is just massive. Using some simplified figures, we're talking about something like $140 billion. Kavya would immediately tell Aman, that is a really, really strong signal. It means Apple has plenty of cash on hand to pay its bills without breaking a sweat.
All right, next up, Kavya would scroll down to non-current assets. She'd probably call these the heavy lifters, the things that are built to last and generate value for years and years. For Apple, this is their giant spaceship campus, all their manufacturing gear, and maybe most importantly, stuff you can't even touch, like the incredible value of their brand and all those patents.
You add all that up, and you're looking at about $210 billion. And that's not just a number on a page, right? That's the bedrock of their entire operation, the foundation for all their future iPhones and innovations. So Kavya would do the quick math for Aman. You add the current and the non-current, and you get a grand total of about $350 billion in assets. That's everything Apple owns. Okay, so now Kavya would flip the page, so to speak, to the other side of that big equation, the liabilities. This is all the stuff Apple owes. And just like with assets, it's broken down. First up are current liabilities. These are the bills that are due soon, basically within the next year. Think payments to their suppliers, any short-term loans, and of course, taxes.
For Apple, that number comes out to around $110 billion. That's their pile of short-term IOUs. But here's where it gets really interesting when we start putting these numbers side by side with the assets we just looked at.
So we've got all these massive numbers floating around, but what do they actually tell us? What's the real story here? This is where an analyst earns their paycheck. They're not just reading a list, they're hunting for clues, for signals about the company's true financial health and its level of risk.
And this is where Kavya would pull out one of her favorite tools, the current ratio. It sounds fancy, but it's super simple. You just take the current assets and divide them by the current liabilities. And what that tells you is huge. Can Apple actually pay its upcoming bills with the resources it has on hand right now?
And when you look at the numbers, $140 billion in current assets to cover $110 billion in current liabilities, the answer is a clear yes. The ratio is comfortably above 1. Kavya would explain that this is a big green flag. It tells investors that Apple isn't sweating its short-term bills. And that financial stability is exactly what lets them pour billions into designing the next big thing.
Another really important one analysts look at is the debt-to-equity ratio. This one gets to the heart of a different question. How much is the company running on borrowed money versus its own money? You know, that equity part we talked about. Now, a lot of debt can be risky, for sure. But if you use it smart, it can also supercharge your growth. It's a total balancing act. This little scorecard here really lays it all out. What are analysts looking for? Well, they want to see strong signals, right? Lots of cash, a healthy current ratio, debt that's under control, and a solid base of equity. On the flip side, the red flags are pretty obvious. Barely any cash, way too much debt, or the big one, negative equity. That's a huge danger sign. But now we get to probably the most critical piece of advice Kavya would share. As powerful as this snapshot is, you can't just look at the balance sheet in a vacuum. It never ever tells you the whole story.
She'd really hammered this point home to Aman. You've got to connect the dots. You need to pull in the other financial statements, like how did the profits from this year, which you find on the income statement, actually affect the numbers we're seeing here? And where did all the cash really come from and go to? For that, you need the cash flow statement.
So if there's one thing to take away from all of this, make it this little mantra. The income statement shows you performance. The balance sheet shows you position. And the cash flow statement, well, that shows you reality. You need all three to get the full picture. It really makes you wonder, doesn't it? If you could only have one, which one do you think reveals the most truth about a company?
You know, when you first look at a company's financial statements, it can feel, well, pretty overwhelming. It's just a wall of numbers. But what if I told you there's a single elegant tool that just cuts right through all that noise? Well, today that's exactly what we're going to do. We're going to deconstruct that tool and show you how to see a company's financial health in a completely new light.
So, how can you possibly get a handle on a company as massive as Apple in, say, under 10 seconds? I mean, it sounds like a magic trick, right? But it's not. It's all about a single, powerful equation that financial analysts like me live and breathe by. And by the end of this, you're going to have that little magic trick in your back pocket too. All right, so here's our game plan. First, we'll cover the key tool itself. Then, we'll break down what a company owns, what it owes, and what's actually left for the owners. After that, we're going to put it all to the test with a real-world look at Apple. And finally, we'll wrap up with why this simple equation matters so much.
Okay, let's dive right in. The entire world of financial analysis, I mean every report, every stock valuation, all of it is built on one simple, unshakable foundation. We call it the fundamental accounting equation. If you can get this, you've basically got the key to understanding any company on the planet.
And here it is. Assets equals liabilities plus shareholders' equity. Now, I know, it looks really simple, but don't let that fool you. The real magic is in the balance. This equation has to balance every single time. It's not a suggestion, it's a law of financial physics. And that, right there, is where the balance sheet gets its name. The best way to think about a balance sheet isn't as a movie, but as a photograph. It's a single snapshot taken on one specific day, like the very last day of a quarter, that freezes a company's entire financial position in that one moment. And it's that moment in time that we get to analyze.
So let's start breaking this thing down piece by piece. We'll start on the left side of that equal sign, assets. This is all the good stuff, everything a company owns and has at its disposal to make money.
So, what are assets really? They're literally every resource a company owns that has future economic value. We're talking about everything from the cash in the bank to the computers on the desks to the patents for their brilliant ideas. It's the company's entire arsenal for creating wealth. Now, as an analyst, the first thing we do is split these into two buckets. On one side, you've got current assets. This is the stuff that can be turned into cash pretty quickly, usually within a year. Think cash itself or inventory waiting to be sold. Then you have non-current assets. These are the long-term powerhouses. We're talking factories, heavy machinery, valuable patents, the things that will generate value for years and years. The mix between these two tells you a ton about a company's strategy.
Okay, so a company has all these valuable assets, but where did the money come from to get them? Well, that brings us to the other side of our equation, liabilities. Liabilities are basically all the IOUs a company has out in the world. It's the money it owes to banks, to its suppliers, pretty much anyone who has a claim on those assets. You can just think of it as the tab the company has to pay off eventually. And just like with assets, we split these into short-term and long-term. Current liabilities are the bills due within a year.
These represent the immediate financial pressures. Non-current liabilities are the long-haul debts, like a 10-year loan for a new headquarters. Understanding that mix is crucial because it tells you a lot about a company's immediate risk and cash flow situation.
All right, so we've covered what a company owns, and we've covered what it owes. Now for the most interesting part, at least if you're an owner, what's actually left over? This is what we call the owner's slice of the pie.
And that slice is shareholders' equity. It's what's left for the owners after every single debt, every IOU is paid off. Think of it as their initial investment plus all the profits that have been reinvested back into the business over the years. In short, it's the company's true net worth.
And here's another way to look at it that makes it super clear. If you just flip the equation around, you get this. Equity equals assets minus liabilities. It's a really simple, powerful truth. What's yours is what you own minus what you owe. For a shareholder, this is the bottom line, plain and simple.
All right, enough theory. Let's see how this thing actually works in the wild. We're going to put one of the biggest companies on the planet under our analytical microscope, Apple.
First up, let's look at Apple's assets. We're talking all their cash, their iPhones waiting to be sold, those iconic glass stores, the priceless brand and patents. All of it adds up to a mind-boggling $350 billion. That is some serious economic firepower.
Okay, so what's on the other side of that ledger? Apple's liabilities. Everything they owe to suppliers, bondholders, you name it, comes out to $230 billion. Now, that is a huge number. But hold on, let's see how it all balances out. So here's the moment of truth. What's actually left for the owners? We take that $350 billion in assets, we subtract the $230 billion in liabilities, and what are we left with? $120 billion. That right there is Apple's shareholders' equity. And just look at this. This is where it all clicks. You've got $350 billion in assets on one side, and on the other, $230 billion in liabilities, plus that $120 billion in equity. It balances perfectly. This is the financial DNA of Apple, laid out in one simple, elegant line. Okay, so the math works. We see that it balances, but so what? What's the story here? As an analyst, what does this actually tell me about the health of Apple as a business? Well, this is the core takeaway. Yeah, $230 billion in debt is a staggering number for sure. But when you see it's backed by $350 billion in assets, the picture changes completely. It tells you Apple has more than enough to cover its debts. And that $120 billion in equity? That's pure, unencumbered value that belongs to its shareholders. It shows a company that's incredibly strong. So let's just bring it all home. Assets are what you have. Liabilities are what you owe. Equity is what's left. It's what you own. And the golden rule, the one thing you have to remember, it always has to balance.
You know, we've just analyzed a single snapshot in time. But imagine lining up 4 of these snapshots, one from each quarter, or 10 of them, one for each of the last 10 years. What kind of story could you tell then about a company's growth, its strategy, its failures, and its successes? That, right there, is the real power of this tool.
Today, we are going to demystify the corporate balance sheet. Think of this as learning how to read an X-ray of a company's financial bones, spotting the strengths and, maybe more importantly, those hidden fractures before they become a real problem. So you look at some huge company, and you can't help but wonder, is it actually as healthy as it looks on the surface? Well, that is the big question we're tackling. We're going to give you the tools to do a basic financial health checkup, just like a doctor would for a patient. Okay, let's dive right in. The most important thing to get your head around is that a balance sheet isn't just some boring list of numbers. No, you should think of it more like a snapshot, a single photo of a company's financial health, taken at one specific moment in time. It tells you exactly what a company owns and what it owes on one particular day. All right, first up in our checkup, we're looking at the short-term vitals. This is basically the financial version of checking a patient's pulse and their blood pressure. We really need to know, can this company handle its day-to-day needs right now? The key idea here is something called liquidity. And really all that means is, does a company have the ability to pay the bills that are due within the next year? Things like payroll, rent, paying its suppliers. The big question is simple, does it have enough cash that's easy to get to cover all of that? So how do we actually measure this? Well, the main vital sign analysts look at is a simple but really powerful number called the current ratio. This is our first and honestly one of our most important diagnostic tools. And the formula itself, it's surprisingly straightforward. You just take all the company's current assets, that's stuff like cash in the bank, and you divide that number by its current liabilities, which are all the debts it has to pay within a year. And that's it. Simple as that. Let's make this even easier by talking about our own money. Your current assets, well, that's like the cash you have in your checking account. And your current liabilities, that's your rent and your bills for the month. Now, if your bills are higher than the cash you have on hand, you know you're in a bit of a tight spot. It is the exact same idea for a company, just on a much bigger scale. So, a very low current ratio, that's a huge warning sign. Think of it like a patient with dangerously low blood pressure. It tells you the company might not have enough cash to cover its bills. Now, usually a ratio over 1 is seen as okay, but it's not a one-size-fits-all thing. What's healthy for a big retailer with tons of inventory is totally different from what's healthy for a software company. Context, as they say, is everything. So we've checked the immediate vitals. Now let's zoom out a bit and look at the company's long-term strength. The question we're asking here is, how much heavy-duty debt can this company realistically carry over the long haul? This brings us to our next keyword, solvency. This is all about whether a company can survive for the long run. And to figure that out, analysts look at its leverage, which is just a fancy word for how much the company is relying on borrowed money to keep the lights on. And the main way to measure this is the debt-to-equity ratio. It's a straight comparison between the total amount of debt a company has taken on versus the amount of money its own shareholders have put in. And if you see that debt bar just towering over the equity bar, well, it's probably time to start asking some serious questions. Why is that so risky? Well, a lot of corporate debt is kind of like having a massive mortgage on your house. If the company is making a ton of money, it's totally manageable, but if its earnings suddenly take a nosedive, that debt can become this crushing weight that threatens the entire business. Okay, we've checked short-term health and long-term strength. Now we're going to play detective a little bit and look for some of the more subtle, hidden symptoms. We're digging into the company's operations and its assets to see what we can find. So here, we're looking for clues that are kind of buried inside the company's assets. For example, is their inventory too high? For a retail company, that's a huge red flag. It could mean people just aren't buying their stuff. It's like having a pantry that's just full of food that's about to expire. Another warning sign is something called a goodwill impairment. Look, in simple terms, this often means a big company they bought in the past just isn't worth what they paid for it, a clear sign of a bad investment. You know, when you look at a company's equity, you can find two totally opposite stories. A really healthy sign is strong retained earnings, which is basically all the profits the company has saved up over its entire life. But on the flip side, you have a massive 5-alarm fire of a red flag, negative equity. This literally means the company's debts are bigger than the value of everything it owns. It is hanging on by a thread. So, we've run all these individual tests. But, just like in medicine, a good doctor never, ever relies on a single result to make a diagnosis. So it's time to put all these pieces together and get the complete picture. And this is probably the single most important thing to take away from all of this. One ratio, or one number, can be really misleading. To truly understand a company's health, you just can't look at the balance sheet all by itself. You absolutely need more context. So how do analysts get that full story? Well, they follow this 3-step process. They start with the balance sheet. That's our X-ray. Then they connect it to the income statement, which is like reading the patient's entire medical history of profits and losses. And finally, they double-check everything with the cash flow statement, which shows the real cash moving in and out, like monitoring a patient's real-time vitals. And that brings us to the ultimate goal here. The whole point of this isn't just to calculate a bunch of ratios. It's to use these numbers to understand the real story and the real risks of the business that's behind them. So there you have it. We've given you the basic tools to perform a financial checkup and read the vital signs of a business. You now know some of the key symptoms of financial trouble to look out for. So the only question left is, which company's health are you going to check first? Hey everyone, and welcome back. Today, we are diving into one of the absolute most important skills in finance, and that's mastering how the financial statements actually talk to each other. Because look, it's not just about memorizing line items. It's about seeing the full story a company is telling with its numbers. So let's get right into it. This quote right here, this is basically our golden rule for today, because the single biggest mistake you can make is looking at any financial statement in a vacuum. It's kind of like reading just one chapter of a 3-chapter book. Sure, you get some information, but you totally miss the plot. To really get it, you have to connect the dots. And to connect those dots, we're going to use a super simple but really powerful framework. We're going to break it down into 3 parts: a company's performance, its financial position, and the cash reality. This little framework is the master key to understanding how it all fits together. Okay, so here's the breakdown of the team players. The income statement, that's all about performance. Did we make a profit this year? The balance sheet, that's our position. It's a snapshot in time. Here's what we own and here's what we owe. And then you've got the cash flow statement. This is the reality check. It shows you where the cold hard cash actually came from and where it went. Now, knowing what each one does is step 1, but the real magic, the real insight happens when you see how they interact. So let's build our first bridge. This is where performance meets position. This is how a company's actions over a period of time, all those sales and expenses, directly change its financial standing at a single point in time. And the most direct, most important bridge between these two is a little line item called retained earnings. Honestly, you can just think of this as the company's financial memory. It's the running total of all the profits that have been kept in the business. It is the critical link. So how does this actually work? Well, it's a really simple 3-step flow. First, the company generates a profit, right? That's net income, and you find it at the bottom of the income statement. Then, that profit doesn't just disappear into thin air. It actually flows, like a river, right over to the balance sheet and into the shareholders' equity section. And finally, it gets added to that retained earnings account. So you can literally see how the performance from this year builds the company's value over time. Now, of course, analysts don't just see this flow. They need to measure it. They need to know how effective it is. And one of the most powerful tools for this is return on equity, or ROE. This one single ratio is perfectly designed to measure how well a company is using its financial position, its equity, to generate performance or profit. And just look at how it's built. It's so elegant. The top part of the fraction, the numerator, is net income. Where's that from? The income statement, our measure of performance. The bottom part, the denominator, is average equity. Where do you get that? The balance sheet, our measure of position. You literally cannot calculate this essential ratio without pulling data from both statements. It's the connection in action. All right, let's move on to our second major connection. This is where position meets reality. This is where we get to ask the tough questions, like, okay, that's a nice-looking position you've got there on the balance sheet, but is it backed up by actual cash? This is our verification step. Here's the way to think about it. The balance sheet gives you the what. It tells you the final cash number at the end of the year. It's the destination. But the cash flow statement, that gives you the how and the why. It tells you the story of the journey, all the cash that came in from operations, all the cash that went out for investments. It explains exactly how you got to that final number. And listen, this isn't just a nice idea, it's a non-negotiable rule of accounting. The ending cash balance on the cash flow statement absolutely must, 100% of the time, match the cash and cash equivalents line item on the balance sheet. If those two numbers don't tie out, something is seriously, seriously wrong. It's a fundamental check on the integrity of the numbers. Okay, so we've built these bridges, we understand these links, so what? What's the big payoff here? Well, now we can finally see the full picture. We can go beyond just reading numbers and start doing real, holistic risk assessment. We can ask much smarter questions and find answers that would be totally invisible otherwise. Let's get practical. Let's ask a really common and really important question. You see a company has, say, $1 billion in debt. Is that bad? Is it a problem? I mean, the balance sheet alone isn't going to tell you. So how do you figure it out? It's simple, right? You connect the statements. Step 1. You find the position. You look at total debt on the balance sheet. Step 2, you check the performance. You compare that debt number to the company's earnings from the income statement. And right away, you get a sense of whether the company's performance is strong enough to handle its debt position. You get context. You get an answer. Okay, let's try another one. This is all about being a financial detective and spotting those weak signals, the hidden risks before they blow up. We want to know if the company's assets, the stuff it owns, are actually working hard to make money. So check this out. It's like finding clues. First, you notice something. Inventory, which is on the balance sheet, is piling up really fast. That's your position. But you don't stop there. You do a cross-check. You look at the performance, and you see that sales on the income statement are totally flat. Ding, ding, ding. By connecting those two clues, you've uncovered a story. This company is making a ton of stuff that nobody's buying. That is a classic red flag you would 100% miss if you weren't connecting the dots. Whew! All right, we've covered a lot of ground. So let's bring it all home and put it together into one master key, a little cheat sheet you can use as a study guide to lock in these critical links. And here it is. Retained earnings links the income statement to the balance sheet, showing how profit is reinvested. The cash balance links the cash flow statement back to the balance sheet, proving the numbers are accurate. And combining the balance sheet and income statement, that lets you do powerful analysis, like checking if a company can afford its debt, or if its assets are actually being productive. This right here, this is your go-to guide. So, at the end of the day, financial statements are not just separate documents. They're chapters in a single interconnected story about a company's performance, its position, and the underlying reality. Now you have the keys to read that full story. So the only question is, what hidden truths are you going to uncover first?